So, Megan, how do you see today, this week shaping up? What's your word of the day?
Yeah. So I think my word of the day is quality. And I think that really describes the environment that we are dealing with in at least the first quarter, probably the first half of this year. The way I think about it, and we define quality as companies that are generating really strong, sustainable earnings while also carrying low levels of leverage. So the two most likely scenarios, our base case is that inflation continues to come down, the economy softens a little bit, and the Fed cuts much more than what we are expecting. And in that environment where you get a little bit of a softer growth outlook, you really want those companies that are generating sustainable, strong earnings. But if we're wrong and the market is more right and rates stay elevated for longer and the Fed is not cutting very much, if at all, next year, then I think you really need to be focusing on companies that do not rely on interest rate sensitive debt for their borrowing needs. And higher quality companies tend to carry much higher levels of overall cash.
Okay.
So I think it's a win-win, and that's why higher quality is a theme that we are very focused on.
I want to go back to your base case. Your base case is a bit contrarian. I think people now are thinking it's 2 cuts, maybe just 1 cut. And inflation, if you even listen to Fed officials, appears to be stickier than we always thought it was. On your base case, at least, where are you getting this confidence that inflation is going down, especially after that ISM read yesterday? We saw companies are preparing for tariffs, and we saw prices are going up.
Well, in all honesty and full disclosure, yesterday's data did not work towards our base case, where we not only had higher prices paid in the ISM services, but we also got an uptick in the JOLTS survey. And what we're watching on the inflation front is really the underlying price pressures if you look at categories of housing and then everything ex housing. Housing continues to come down, but it's stickier than we would like. But if you look at the categories outside of housing, that has been at or below the Fed's target for a number of months now. And we just do not see the conditions that would really be necessary to see inflation stay here or even reaccelerate, which I think is the Fed's concern. The labor market, we
Megan,
think, is a little bit weaker.
I want to switch gears just a little bit from the Fed because we want to make time for you to talk about this. Your pick for today, what is your pick and why?
My pick is banks. And this is another sort of, I think, win-win for the year ahead. Banks were a key part of the broadening leadership story that we saw in the second half of last year, but that was almost entirely reversed in December. And we expect long rates to stay elevated. We think short rates will come down. So you're going to get really a nice rate environment and a steeper curve for banks. The thing to watch will really be credit quality. Business bankruptcies are very low. Consumer credit quality is a little bit rockier on the lower end.
All right.